private sector development in emerging markets is being challenged by the COVID-19 pandemic. Raising funds for a new business or even expansion of existing one could be an arduous task. To be honest, it is a challenging task and it's always going to be so. All the more now when with the economic downturn caused by the global COVID-19 pandemic has people questioning their futures and livelihood. Raising capital in a post-COVID-19 world is going to come with a lot of obstacles and it's only smart to prepare for it. Our next session that focuses on discussing the future of fundraising and investment post-COVID-19 is moderated by Anand Lunia, General Partner, India Quotient, who is joined by Karthik B. Reddy, Managing Partner, Bloom Ventures Advisors, and Ganesh Rangaswamy, Managing Partner with Kona Capital. Welcome to the FinTech Festival India, everyone. The session is all yours, Anand. Over to you.
Thank you, Amit. Hey, welcome, Karthik. Welcome, Ganesh. Great to be on a panel. Always good to be chatting with friends here. Just want to ask how you guys are feeling today. What is the emotion? For me, and I'm sure for both of you as well, the last 2 years have been a roller coaster ride. Right? I mean, got into a big panic mode, asked our companies to reduce burn, figured out where the money will come from, the state of the fund, whether we can even draw down capital, etc., etc. And then the companies came out, with blazing guns out of COVID. Most of us, right? I mean, most of the companies, the portfolio did very well, beyond expectations, and we were exuberant. And exuberance followed some amount of funding. But what happened was that today the amount of money coming into the system is giving like the exuberance is now giving way to nervousness now for me particularly. Right? I just want to ask Ganesh, how are you feeling? What's your emotion?
Yeah, thanks, Anand. I think you. So the only couple of things I'll add is clearly one of the secular changes we have seen and across markets. Of course, we have prolific investors in India, but we have fortunately vantage point of global emerging markets. Across markets, we are definitely seeing a secular sort of rise and shift to digitization in a very big way, in very nuanced behavior. Right, where things which in the past would have been just a matter of customer inhibition or partner inhibition or ecosystem inhibition, those things are changing. Walls are being broken down rapidly. Some things will stick, some will not stick. But I think as this is getting prolonged, it's likely that more things will stick than not. Mm-hmm. Now, on the back of that, the challenge on the back of that is, at some level, the exuberance around digital opportunities and platforms from an investment perspective is almost becoming removed from probably the reality of non-digital world in the midst of COVID. And to your point, through this 2-3 cycles of ups and downs, what we are seeing is the starkness of that exuberance reaching sort of a peak. And even though we all believe in this, in the digitization of the ecosystem, and we're seeing it happen in front of us a lot more rapidly now, I think the real question in my mind is how many companies are of the caliber relative to the kind of investing frenzy we are seeing in the market right now. So that is really a challenging question, because that's really that has a significant impact on the ecosystem, on the psyche of entrepreneurs, and the psyche of investors. And that's where, even though I think the exuberance is justified, we are probably we have reached some absolutely unbelievable levels in terms of the madness. And the corollary to that also is, at least from our side, we don't see this settling down anytime soon. Because a number of us have lived through the 2001 and 8 crisis. There was really capital sucked out of the system at that point in time. And we did see a significant sobering of the ecosystem, and we exited my first startup in 2008 crisis, end of the crisis, and we knew what sobering of ecosystem meant. But today, given the extent of wealth in the market and interest in private markets, if anything, we are seeing over exuberance. There is no slowing down at all, and that's part of the challenge. We can wait for first principles to settle down, but it's unclear how long we will see this kind of exuberance and what it means to the ecosystem in longer term.
Ganesh, you are saying that the exuberance might stick forever, right? So that's
for a while, yeah.
So, Karthik, this is the worry, right? I mean, we are exuberant and our tone is nervous, right? So how do you rationalize this, and what is your emotion?
It is confusing. I guess you caught me at the end of a week, which has been personally very confusing on all these fronts. Mm-hmm. So I'm not going to deny that and be very honest, especially at the end of the curve where most of us sit, which is early stage investing. And essentially you're being asked to make bets into an environment where you have to forecast what the world will look like 5 years from now. That's when the bets are going to play out. As I think you rightly pointed out in our pre-chat, your existing companies are benefiting from this. There's no doubt. Yeah. And it's foolish not to take advantage.
Of course.
Also, right? Good founders know how to hustle and take advantage. So you've got to park your gains, your outcomes, your exits, everything, and ride the wave. There's no doubt about it. And if you're smart, you will actually conserve the capital that you raised. You won't squander it foolishly, right? I think the smartest founders will be the ones who leveraged or arbitrage the opportunity to take as much capital as they possibly can at the best possible valuation, but use it as if there is a downturn, right? Not as if there is, unending euphoria, unless your customers are voting in your favor, because that's the only dollar that matters. So at one level, a profitable customer is the god, right? As they taught us in business schools, customer is king, customer is god. So if you're able to drive that traction, then of course you should plow more money, right? But if you're not seeing that momentum, and to Ganesh's point, if you have half the country struggling on the back of a post-pandemic environment, you can't force them to spend on you per se. You can help them. If you're helping them and you're making money and they're willing to pay for it, of course you should plow down on the business as well. So 3 big trends for me, right? So one, I'm a huge believer and a seller. All of us are selling new funds. You know that as well as I do. And what do we sell? We sell the macro that India is a phenomenal opportunity for digital, right? I think physical infrastructure, physical rollout of what we think is essential financial services, that's the forum we are in, healthcare, education, these are not going away. These are day-to-day needs and they're there for perpetuity. And I don't think legacy infrastructure, legacy models can take more market share, is my take. Right. So they're there for you to take. So these are winning markets to win. And if you even it doesn't matter the timing of the $5 trillion economy. The fact that it has to get from 2.5 to 5, a lot of that is yours to take, is my view. So that's what I sell, right? When I sell to international investors. That's the India digital opportunity. Now, within that, I feel you shouldn't fool yourself into selling something that people don't want or don't want to pay for or don't want to pay profitably for. Everybody's margins have gone up because food delivery was a necessity, not because it was a luxury like it was 5 years ago, right? So we shouldn't squander those opportunities and build better business models in India. And I feel the counter to everything will be eventually the wisdom of the public markets. So as much as VCs who don't want to believe that public markets are wise and superior, I actually believe that they are the end state of all financial market outcomes, right? The guys buying most of our companies eventually are public market companies or they end up in public markets. So I'm delighted that we are taking this risk to the public markets, because then the wisdom of the crowd sets in. It's not like 10 people sitting in a room foolishly deciding what Indian tech should get to. It's thousands of people and lots of asset managers who will ask tough questions. And that will be the sort of day of reckoning. The last part is, I think, with each downturn, the world resets as a whole. And this was a forced one in a very peculiar way, which I think for the first time has opened up the opportunities globally for Indian entrepreneurs. So what you saw this week, Eruditus, or what you saw in White Hat last year. So if you're seeing in education, our company, Healthify or Ultrahuman getting funding right now, is not for India, it's for global markets. Right. So the confidence to go win in global markets suddenly expands your market opportunity to like 100x, right? So who cares whether you're doing 20 million ARR in India? You can do 200 million globally. You have to have the courage to do that. Historically, there was no belief system. Now I think you're seeing enough case studies of that happening as well. And I think all these put together still weigh in the side of benefit of doubt that we're on to something good. I think we shouldn't foolishly squander this opportunity.
Hey, Karthik, you are thanks for being optimistic, right? But let me just come back to the question of, where we operate. Right? In our world, and this is important for a young budding founder today, right? I mean,
yes,
a Series A would be a check for, because you have a promising market, right? You get a Series A, right? You get a Series B and C, maybe 50 million, 100 million, maybe even lesser, because you need for growth, right? To build a team, build an organization, to grow, right? But today what we are seeing is, that like a Series A is a check for discovering the market. And even $100 million check is also for discovering a market, right? I mean, you haven't even discovered, leave alone being a promising company. And in that scenario, founders who are entering entrepreneurship for the first time, even for return second time, right? How do they view this? Because the way we can't rationalize some of the companies that are being funded, or some of the amounts which are being funded, more importantly, even founders also wonder, right? I mean, they start like saying, okay, which parameter do I need to hack, right? So instead of daily number of hours of viewing, should I change my metric to daily seconds of viewing, right? I mean, and they are actually perpetually trying to hack something to grow into what they think, right? Investors like, right? So my question, I mean, both Ganesh and you, starting with Ganesh, Ganesh, how should young founders entering entrepreneurship today read the funding boom, right? And some of which like Karthik said, right? We can't fathom, some of which is like, even public markets, we can't fathom, right? So how should a founder view this, and how should he play? Or she play, sorry.
Yeah, Anand, I think it's a tough question. And like Karthik, going back to Karthik's opening remark, it is confusing because there are certain principles, some number of us that I think have been around for a while, and we have come up with certain principles, some of which you might also question, frankly, in these times ourselves. So for young folks, it's even more confusing. I think it is true. There was a time when you would say 10 out of 10 times, building a longer term company would make the difference, and you sell the vision market wants to hear, but you build the company you want to build. I think it's very important to keep doing that, because it's it is hard to have everyone understand your vision and believe in it all along from the early days. It's just hard. If everyone believed in it, then you're probably not doing the right thing, because everyone knows what you're trying to do, right? So fundamentally, you are going to not be understood, or people are not going to get it, or say, look, it's not, I mean, it's fine. It's an interesting thing, but I'm not sure it's a big opportunity. You'll hear all of those things. So you need to sort of connect with the market in your vision if you want to raise capital and be a market leader. But you need to keep executing the direction in which you want to, and that can be very confusing for especially for first time founders. It requires a Zen level maturity, whether it's whether you start your own fund, frankly, or if you are sort of running your own company. It requires a certain level of maturity to balance those things out. Now what's happening in the middle of that, like you said, is people come up, not just new founders, right? Even seasoned founders come up and say, okay, if somebody is able to pitch a story and raise $200 million, and I have raised 50, my team looks at me and says, okay, what are you doing wrong, right? And then of course there's somebody who's raised just 5. So it is a very real question, and and COVID has made it more challenging. The ability to sort of stay even more. Again, it's paradoxical. At some level, it's made it challenging for the team communication to flow easily. At the same level, some founders have actually leveraged these times to say, we have to stick together, and as a team, we will make it happen. We will actually make it. So it's kind of an interesting dichotomy we are seeing. Some companies are falling apart, and some companies are leveraging this to say we are on warpath, and let's make it happen. But most importantly, I think the role of founders, and even, frankly, our roles as a coach is becoming a lot more important. It's not that I'm a professional coach or anything, but the ability to help the team understand that it's not, fundraising a inordinate amount of fund. Well, I mean, if you raise billions of dollars, it's a different debate. But in no level of significant fundraise can eventually hide a bad business model. But for people to believe in that, you'll have to see 1 or 2 cycles. And the only thing we say with young founders is exactly what Karthik mentioned, which is, guys, if we can raise capital in these times, let's take advantage of it, but let's not fool ourselves even for 1 second. That means we are a better company. Let's figure out what we track to as a company, and it is a difficult balance. And I think there is absolutely a huge degree of confusion across the ecosystem, and every large round is making it worse, especially if you can't understand how this company raised it and what are they doing to deserve that.
So Ganesh, I mean, you said that your vision can be what it is, but you have to sell what the market wants to see. But the market is us. We are the investors, right? We are the market. Now, if a founder of mine came to me, and I've had actually, there's a board conversation I'm reciting here, that the founder says we should stop measuring our ARR revenue and we should start measuring the amount of this accounting software, start measuring the amount of transactions we record, right? I mean, or another founder said, my own brand is not doing very well, but hey, I know how to build a brand. Should I pivot to Thrasio, right? Now, I mean, I am sure all 3 of us will agree that, we as a market will not accept these changes, right? We're not going to put a lot of capital, if we could, behind this, right? So it's sort of confusing, Ganesh. I mean, you have something to add here? I'll take the question to Karthik also.
I'll just add one line, just to qualify what I said, and then I'll turn it over to Karthik, which is, please do this after I invest. Don't do this when you're pitching to me. But Karthik, please go ahead.
So, I didn't want to put you in a tough spot, Ganesh, but I'm actually in the same boat as you are, right? I mean, how do you balance? And we want our companies to raise my money, but we also want them to keep doing the same thing. Karthik, okay, what are your views? And I have
so quick views. Ganesh covered most of it, all sound advice. So from an early stage founder, I think there are basically so my good friend and colleague Sajid has come up with a cute term for this, right? He calls it fluent founder. He blogged about it last week, right? So I'll put it more bluntly. It's basically in the spectrum of form versus substance. A fluent founder understands form far better than substance. Not to say that it is a mutually exclusive set of qualities.
This is a sign of Karthik.
But basically, you have to be careful about the ones you pick. Do they also have substance, right? If you go to the form end of the spectrum, then this is not going to, it could, like, that's what I said, you're absolutely right. People, so you have to, as a founder, since you asked me, and we are speaking to founders on the other end of the stage, founders have to know who they are, right? So second-time founders are taking advantage of this. Why? Because they have track record, reputation, they have a little bit of this fluency developed from selling a company pre-Series A or Series A or Series B. They brought back that experience and said, this time I'm going to pull one on the investors. Right? The market is perfect for them. Then, and that fluency scale, first-time founders, they're built like that by DNA. You can't suddenly inject something, another vaccine to them, and they become, form versus substance. Right? So they're either one or the other. So I don't think the substance folks can fake it. They're going to have the toughest time in this market, right? Because they are. It's not like all the points that Ganesh spoke about is post facto. We are all seed investors. So when you're selling to me, I still need to, my first principle, thank God for it. At least that's, I think, the reason I sleep well at night, have not changed in the last 18 months, right? We've cut frequency, we're probably one of the lowest checks across most of our peers, right? We've done 8 or 9 or something like that, relative to our original pace. People just tell me, we've done about 5, I said, we met meeting founders, on Zoom. So I said, how do you gauge this person on Zoom? I said, no, we're doing 5 calls additionally than what we would have done before. We गलती से एक term sheet दिया without meeting in person. So only one term sheet in our life we have given without meeting the final team in person. Before the money wired, 3 of us in the partnership met them, right? In the leadership. So I just didn't get comfort with that idea. So I think if you're, that's why I said, I think as an early stage investor, when you're giving $500,000, $1 million, and $1.5 million, of course, if you're asking for more money than that, then some of us are the wrong crowd, right? You can't go to funds of this nature. And that's why I said the fluent founders are driving the headlines. But I'm a believer that when the script is written on the 2021 vintage, we will have both types of winners, right? There are smart founders who will take advantage of capital markets, raise very well, pivot the entire business model and build an entirely different business with 100 million they'll raise 2 years from now. You can't stop that crowd. They're phenomenal in doing what they're doing, right? And there'll be another set who've been ignored for 3 years and they will come back, rise like a phoenix, right? Whether that is, as Ganesh was saying, eruditus, it never raised a round, or look at Gupshup, 10 years, no financing. Look at Exotel, 8 years, no financing. You can't kill an entrepreneur spirit of that nature. They're building foundationally very strong. So they'll both will come out of this cycle is also my belief. But I think the headlines are currently being swayed by a very different phenomena. Since we're on the topic, I want to add that what is being funded today is the ability to build digital behemoths. I don't think there's any business consideration to give somebody $500 million, right? You're essentially saying new digital conglomerates can be built in this country, right? Otherwise, my good friend Harsh is starting a $250 million fund, right? So somebody else raising 500.
So you're saying, Karthik, one doesn't need a plan. As long as you're a fluent founder, it's good enough, right?
Partly, and the bigger the fluent founder, the more flexibility you're getting, right? You're getting to start funds inside your company. You're getting to do some sidecar stuff. You're getting to buy 10 companies. So, all the way from Baiju downward to the person who's taken, the most recent $100 million. It's not for organic growth fundamentally. It's basically like, it almost feels like, yaar, ye sab chota VC I cannot do. आप कर लो आपके balance sheet से. मैं 200 million ऊपर से देता हूँ. It's almost like the growth VC becoming an LP for ideas.
So everybody's building a threshold model, Karthik. That's what you're saying.
Correct. So today, I was just eating some Parsi food with the team today at office, and it felt like I just remembered Riaz Amlani was doing this much before the word Thrasio came into the lexicon, right? He basically wouldn't own any of the restaurants. He would basically take the idea and build a restaurant growth format for you. So these formats have been around. In the offline world, they've been around. In the online world, they've been around. But basically, they've taken peak right now because there's so much capital.
So let's go to the founders of substance, right? And thanks, Karthik, for the classification. Now, how does a founder of substance today? There are a lot of options, Ganesh, right? I mean, the first round of funding, particularly for a young founder, right? I mean, there never been so many options, right? I mean, like raising 1 million, 2 million. Actually, you have a choice today to make, right? What would you recommend to a founder in terms of the choice? Because like you said, there will be kinds of VCs who sort of like a different kind of vision, and there are VCs who will prefer execution to a very narrow vision, and people who don't want to fund a threshold, right? So and of course there will be other parameters also. So how does the founder select? And were like all the criteria of the past, things like signaling risk and all the good stuff we used to do, right? Are they still even relevant today, Ganesh?
It's a good question. Anand, I think, look, there are certain things will stand the test of time and relevance, but in confusing times, you obviously doubt those things. I think in general, venture industry is changing rapidly, and how entrepreneurs get access to capital is changing rapidly. Having said that, I think some principles will never change. This is so much about people and leveraging and not having to not having to do all the mistakes yourself and learn from people who have done those mistakes. Again, I frankly don't believe anybody's been there, done that, but the ability to apply some mistakes people have done in a different context is still very valuable in your own context. So you don't get stuck in the same rut. So I think like for example, one of the discussions having with a very seasoned founder in our group, he said 10 out of 10 times I would go with the person, firm, and then terms when I look at a deal, right? Who am I going to work with? What is the firm's then what is the firm's credibility, and then what are the terms they are giving? In fact, one of the founders who is now an LP in our fund, and we exited the company to Gojek, said, and it was a little bit comical because he said this in a public platform where he and I were both speaking. He said, if you had given me 30% lower valuation, also I would have taken it. Of course, he said it too late after he sold the company. Unfortunately, I should have known before. But the point is, I think some principles don't change at early stages, especially. People really need folks who can be supportive, who can believe in your vision, and who can evaluate for that, the point Karthik was making, for substance, or see the basic ingredients of substance. So just like I don't think, and I've said this publicly multiple times, I cannot deal with a fully fluent founder, period. That is just my limitation. Too bad, right? We just can't do it. Same way, the founder has to evaluate who they can deal with and who they can work with. I think it's extremely important. People do not realize it's a marriage. It's very, very hard to break, right? It's not easy, even if you want to exit. Secondly, you have to test people. Yeah, if you have been trying to solve some problems for a while, you have to test the people who investors you go and talk to in terms of how they think about those problems. I mean, they may not be deep experts in domain, but look, several of the challenges in entrepreneurship are also kind of generic, and there are some macro stuff. You will know through the interaction how much this investor can bring to the table, not in terms of just their thinking, problem solving ability, how they make you feel. Are you going to feel judged all the time, or are you going to have somebody who can think with you, making things happen? And everybody has a different philosophy. We have seen guys checks and don't even show up for the board meeting, right? Or don't want to be on the board. So there's all kinds of folks. You have to decide what you want as a founder. Our suggestion to founders always is seed, pre-A, A level, A, B. Even you need folks who feel vested in what you're doing and are excited about what you're doing. You want the feeling, just like you and Karthik and even we, when we do early, obviously come with a firm belief. That's why we are backing these founders. Till Series B, at least we want that. Right. After that, if you're going to say, look, I think I need access to huge pools of capital and somebody will let me run with what I want to do and all of that, that's fine. But you need to reach to a stage of founder product market fit, not just sort of there is some product here, some market here, the founder is still kind of fishing what to do. I think you need to get to a certain point where you're established, and then you can run with depth of capital. I think till then, it is extremely dangerous, in my view, extremely dangerous to take capital too early. From folks who may not really, be wedded into your business, but look at it as one more portfolio expansion. Or like, I'm betting on the race, I'm not betting on the horse. So I'll invest in 4 guys in the same space, right? And as a founder, do you really want it? Especially when you're making 30, 40, 50 million investments in each. So these are questions founders have to answer for themselves. I think except for out of our 45 portfolio companies and about 17 in Asia, we have only one instance where we have had, a difference in opinion on this after investing. So far, we haven't had a situation like that, but it is complex. You need to be constantly in dialogue to figure this out.
Got it. Thank you. Ganesh, Karthik, unless you have something to add, I had a related question, right?
No, I think very eloquently captured. I think what doesn't get spoken about, all three of us should know it as early stage investors, is founder-investor fit. You pick founders that you like to work with, and invariably founders are smart enough to pick investors they like to work with. Those are the best kind of marriages. It's not just about Series A, B. I feel early stage is a very different stage where you get married to each other because you want to build something memorable, and at least the idealism starts at that level. It might drop after 2 years. And so if you don't feel like, at least from my lens, for a founder, I'll tell you, if I don't feel like I can have a drink or a chai with you 15 years into the journey, irrespective of what happened in the journey, then clearly you're not a founder I'd want to work with. So you have to be able to make the same judgment on an investor. Otherwise, you're destroying your best years of your life trying to build something for what? I mean, so you should have investors also back you to the hilt on that.
And Karthik, very relevant today because there is choice, with the founders.
Yeah, absolutely.
I mean,
Absolutely.
5 years ago, this option was not there. So Karthik, the question for you is we're talking about a lot of unicorns, right? I mean, and you mentioned the word very rightly, digital conglomerate, right? So everybody wants to build a digital conglomerate, right? But if I look at China and America, right, the core of their startup ecosystem is with companies like Fang, right? I mean, and Microsoft and Apple. I mean, these are the companies which form the core of the whole thing. Now, what will take, what will it take for us to see similar companies in India? Maybe we have a InfoEdge, maybe a Zoho, right, which are becoming like institutions, very profitable and look like that they are here to stay forever. Zerodha is coming out to be one, but very few compared to sort of the number of unicorns we have, right? What do you think needs to change, and any advice again for founders?
No, I think, see, the early stage founder has our audience has a long way to go before they get to that scale, right? But you're absolutely right that from a role model perspective, they need to look at businesses which figured out how they're going to build substantive, sustainable business models over a period of time. All of what we spoke about is like jugglery, financial jugglery, and it's a very different game. With the core business, so if you ask me rules of thumb, whether it's Freshworks doing it in the US or whether it is Delivery or Lenskart or Policy Bazaar, which I, by the way, 2 years thought will be our first public companies. Why? Because I thought they had one core business model, no confusion, right? The math around the way they constructed the business model was viable, and therefore at 2, 3 to 5x the scale, they could be eminently profitable, and they were the market leaders in their space. And going post-public, in that $5 trillion journey, they could have become 5 to 10 times the size. That's what I would like to see in my end state outcomes. I pray and hope that if I can get, a dozen unicorns and all of them go public, at least half of them land up the way I just mentioned, right? Both the path to get there, so there's no faking in getting to that journey. And once you get to that journey, I might be out of the cap table, but you please continue to build 5-10x from there, right? That's the Fang model, right? In a nutshell, right? So these were like Tencent was $1 billion company. It went to $500 billion over 12 years or 10 years.
Yeah, absolutely.
So why can't that be? I mean, to me, for all the effort we've put in over the last decade, the aha moment in saying that, we built something of value would be seeing those outcomes at scale.
Yeah. No, I tell my founders, Karthik, that I want to see your kids fight over who wants to be the CEO, and they should come to me to Anand Uncle to mediate, right? Because
that'll be fantastic. That'll be fantastic to see some of these.
Fantastic to see, absolutely.
Yeah. Even if 5 out of 100 this happens, it'll be so cute to watch.
I mean, the company has lasted that long and is growing, and it is worth for siblings to fight over, right? I mean, that's what we want to see. So, okay, just last question before we wrap up and open up for questions. Ganesh, tell us what's changing in the fintech space, right? And what do you think will happen next? I mean, what new businesses you are expecting to see in the fintech space in India, and what's changed in the world? If you can throw some light on that.
I can tell you what businesses I want to hear less about, starting with neobanks, but I know that's not what you want to hear. But because that list is pretty long. But I think in general, Anand, it goes back to what on the back of the new data stack, evolution of digitization, how can we really bridge fundamental mainstream financial services needs with and scale it up on the back of the data and tech architecture we're starting to see. That's one side of the theme, and I'll mention a couple of examples there. The other side of the theme is financial services is so two things keep happening. You have, every time there is a step jump in innovation, you will see unbundling and more specialization across, even within financial services, you've seen this cycle multiple times. You take insurance, payments, lending, investment. With every step jump or a different way of doing things, you will see unbundling. And then at some point, you'll see dominant leaders emerge and you'll see rebundling. Right? Yeah. That's one. What the new thing that's happening this time is I think we have the tools, whether it's from a customer openness, ecosystem maturity, platforms, data tech, where financial services is going to become rapidly a lot more contextual than being transactional. It's not about just making a payment in isolation or taking a loan in isolation or insurance in isolation or whatever. It is going to be a lot more contextual, and hence it's going to lead to a lot more verticalized solutions. So whether it's if you start seeing B2B commerce as one of the leading examples, you'll see a lot more verticalized B2B commerce solutions, and even within that, number of them actually are building almost a parallel pillar of financial services in terms of their data integration of transaction, data, payments, credit, and other solutions they are providing, etc. It's almost becoming a parallel pillar. I think the days of financial solutions being transactional is slowly going away, because there is an opportunity in the world to build integrated solutions, and they're necessary, and that builds a much more longer term moat. Now, around that theme, we are seeing exploding number of opportunities. You take different contexts, you take different verticals. We're seeing whole host of things around that. I think the danger here goes back to number of things we have discussed, which is around fluent entrepreneurs actually taking advantage of this thesis. So you hear a lot more talk than folks who can actually execute, right? And that's part of the challenge. At every time a large funding happens in a company which we believe is more form than substance, it sucks away capital from companies which have the substance. And we all know names of companies and we can talk about it, but that is a huge disservice to the ecosystem, because if someone with substance, because they cannot speak English or cannot articulate as well or storytell, is not able to survive because they are completely overshadowed by someone who's raising 50 times they can raise. That is a tragedy, and it's happening in front of our eyes every day, and we all see this.
Yeah. No, Ganesh, very interesting. From what you are saying, if fintech is becoming contextual, right? Fintech is a feature will actually come true, right? And a lot of fintech will be done by other businesses, right? We are already seeing SaaS is approaching fintech, and commerce players are approaching fintech, and standalone fintech will be far and few, of course, maybe not in the consumer end, right? The consumer side of fintech is sort of getting absorbed into the verticals, like you said, right? Vertical application of softwares.
Yes, but I would say it a little bit differently, because for the first time, or in a dominant way, I think we have seen this in the past as well, but for the first time, I think we have fluidity of ideas and concepts and use cases time to merge because of the opportunity that digitization and data and innovation is providing. So whether it's SaaS, whatever, health tech, ed tech, fintech, wealth tech, SaaS, different frameworks, or open finance, open data. So you're starting to see things merge, converge, themes and ideas converge depending on who has better execution. Like within a certain idea, if let's say HR and SaaS and fintech are merging, depending on who has better execution, that platform might become the dominant platform. It could be HR, SaaS, it could be fintech. I mean, I don't know. So it really comes down eventually to execution when this ideas start merging, and who has an upper hand. But it's it is going to be a fascinating play, as long as it does not get detracted by the confusing large rounds we see and start wondering why somebody is getting funded, which is a real problem. I mean, I don't want to keep coming back to it, but it is a real problem. It is hurting a bunch of other folks who can actually create real companies but cannot fundraise.
Ganesh, my view is that the good part is there was a time 5 years ago when if somebody scores a large round, everybody else will stop funding in the space, right? The winner was declared the moment somebody touched like $100 million raise. The winner was already declared. Right? Good part is that's not happening today, and hence a number 2, number 3 player, at least in the terms of fundraise, will still keep getting funded, which is good. And eventually, while there will be a short window where the profit will be sucked out of the system, the better players will still win. It'll just take longer time, right? The wrong players getting funded will probably delay your eventual win, right? You just hang on.
That's
there. Karthik, the question for you again around business models and fintech, right? A lot has been said about how fintech is the nirvana. Your core business isn't large enough, doesn't make profit, but fintech will help you get there, right? How do you view that?
No, I'm not a huge fan of the thought. I like the idea that it should be more of a horizontal and it has to be absorbed by every business. It adds to margin structures. In fact, on a standalone basis, it's a much tougher business to execute, if you ask me. Right? If you take, let's say, I want to go build a new car loans business, it's much tougher than to layer, lending and insurance on top of a Spinny's business, right, which sells cars. I don't think it's as trivial to go and be a B2C or a B2B2C player. You can be a technology stack, and that's how all the payments companies grew. And look, they've done very well. But fundamentally, whichever lens you approach it from, I've always believed that the largest opportunity set in this coming decade is in the hands of fintech. If the economy grows, the flow of capital is what creates fintech opportunity.
Agreed.
And that all of it used to create a margin structure in the value chain. I think fintech's ability to destroy that margin structure and make capital efficient is the opportunity for new companies, right? The legacy companies created so much friction in the flow of money. Those stupid business models, they need to be destroyed, right? And that is the opportunity set, which is wide enough, if you ask me. And it'll either play out as B2B infra of like payments, etc., which manage to do that, or you can build phenomenally interesting consumer propositions. Like we love small case in our portfolio for that, or it can be, it can become a horizontal service on verticals where I won't call it fintech. I mean, I will never call Spinny a fintech business just because even if it makes more than 50% of its money through lending and insurance, right? So I don't think that we should confuse the two, but yes, the ability to architect fintech into every business model, every business is almost essential because it adds that margin layer that nothing else can. And it's all virtual. It flows fluidly, right? That's why you have a crypto unicorn and blockchain.
Every business has to be a fintech business. It's sort of mandatory now. You can't really outsource. And like Ganesh said, it has to be contextual. I'll move on to Q&A. And first question is for Ganesh. Ganesh, and we've seen this when you evaluate a fintech startup, right? I mean, you see a team which has solved the fin part, right? Let's say they're finance professionals who are sort of very good in the finance part of it and have proven that, have innovated something, discovered a new market, all of that, and now want to raise money and sort of add the tech part, right? And the tech part is not necessarily that fleshed out, but it's a solid business, right? But somehow these businesses are less out of favor today. You are an insurance distributor and profitable, you not get funded. But if you are a loss-making software which can add insurance, you will like a unicorn, right? For example, right? I mean, that's how the market is treating fintech entrepreneurs who are coming from the fin side. How do you view and what would be your advice to them?
That's a good question, Anand. I think what the market is saying is, back to Karthik's point, there is a lot more of growth potential and opportunity to build on the back of new age foundations for scale, as opposed to trying to build the linear way that we have historically seen things being built. So that is what the market is telling, and there is some truth to it. Again, I pretty much don't generalize anything anymore. Everything is a shade of gray. There is no black or white in anything. So back in the days, I think there was first version where we used to look for fin entrepreneurs. There was second version where we said, it has to be maybe more tech, right? And frankly, what we look for today very carefully is a healthy blend. It could be two founders, it could be whatever, but there has to be a mix where you have to respect the financial dynamics component of it. You have to respect the regulations or respect the ecosystem, but you need to figure out what are the levers that are going to help you really scale. And if you cannot understand the dynamics of the digital ecosystem, which is the fastest growing ecosystem in the country, I just think you won't be able to build and run with the best in the market and come out as a winner. So it's less about, I think, again, more from a fundamental point of view, it's less about tech or fin for us, but we need folks who understand the ecosystem and respect it and respect financial services and to know the nuances. But it's very important to be able to know how to really build a company for new age and not sort of build the way you have built it 10 or 15 years ago. That's just not going to cut it. So you need a blend.
Yeah, nice. Karthik, a different question for you. Indian companies have threatened to do EBITDA positive for a few years now, right? I mean, and when people used to say that we'll go public, right? The implicit assumption was that they will become EBITDA positive and hence go to public, right? Public markets, right? But that's sort of like, are we saying that that's not required now anymore? And the conversation around EBITDA positive should end. One, and two, it's still very difficult in India to be EBITDA positive, right? I mean, what's the driving factor, and what do you think will happen going forward?
So, no, that's what it goes back to. My dream was to see these first of these EBITDA positive companies hit the public markets.
Yeah.
All three of the ones I mentioned actually picked up a SoftBank round instead.
Yeah.
So then I was afraid that, oh my God, if we postponed like this to no path of no return, because the markets would like to see some money left on the table for them. That's my worry. That's my biggest worry, actually. I think public markets are not markets where you squeeze out the last drop of value.
Yeah.
You leave everyone to make some money happily, and then hopefully that scales to 10x, and people are very happy that instead of 10, you left 12x for them. But so I think the markets being, I said this in a panel with Sanjeev actually, and Sanjeev said we doubled on the first or second day, and we're very happy for those shareholders who made money, and that's how it should be. So what happens when you try to squeeze the market out and get these fancy, sexy private valuations is public markets don't understand what's left for them. Why should we buy into this? And so that's one fear. But I think inevitably the market will judge them by, is there an end state, right? So form versus substance will get resolved far more in the public eye than in, as I said, the eyes of 3 or 4 guys who can cut $100 million check. And the quarterly cadence is a fantastic thing. I feel like after 10 years, if you're not capable of that, why call yourself a credible company? I mean, so it's not about just, I don't expect a 3-year company to show that and go public. No, there's no question about it. But if after 10 years you're making excuses, then why are you around? What do you expect? That you'll get your losses financed till ad infinitum. So that responsibility is going to kick in. Earlier it happens, the better. And yes, there will be phases where companies will get, the ability to build, as you said, metrics growth, which has nothing to do with profitability or revenue. Yeah. And they will enjoy those phases, but eventually I think they're going to be answerable to the classic paradigm of how things are valued, either by public or private or M&A buyer. Right? I don't think this flaky math holds up for too long.
Yeah.
Anand, can I please add? I want to make a point there, so that we emphasize the right lesson. Like you said, this EBITDA or profitability not being important anymore is a dangerous lesson. I know you are asking it to instigate, a response, but it is a dangerous lesson for anybody to take away. If folks listening to this are taking away, and for ages we have seen phenomenal companies in this country being built, tech or no tech. I mean, AU Finance. And whichever market, whether it's India or global, Freshworks, I mean, latest with Eruditus, if you look at their balance sheets, profitable, look at Digit, look at AU, I already mentioned, Bajaj Finserv, etc. Valuable, phenomenal companies have been built once you take a 15-20-year view, and which are sound businesses, loved by customers, and with significant profitability. I think the challenge in this case, what is happening right now, I would solely blame investors. You are creating the liquidity for entrepreneurs to feel that you can keep going, and there is somebody who is going to keep funding your, in several cases, the bad behavior. I mean, not in all cases, but in several cases, we are funding that. And in some cases, You have rounds happening just before going public, which is kind of playing out the market making on public side as well. So we are rather trying to hack the system than trying to build a successful and sustainable enterprise, because at some point you say, okay, it's time to create liquidity for ourselves. So I think this is really more of an investor dynamic and too much capital in hands of investors, frankly, than blaming entrepreneurs for it. And it is a dangerous lesson for us. Maybe the first one will work, the second one will work. I don't think that trend will sustain in public markets.
It won't. Ganesh, I agree with you. It won't. I think on that note, I think we should wrap up the discussion for today. Fabulous discussion. I think all of us feel that this is a good time for entrepreneurs to leverage, raise some funds if possible. However, they have to stick to what they're supposed to do. Right? Stick to the basics. Stick to executing the right thing. And of course, the headline for me was what Karthik said about the fluent entrepreneurs. Definitely you will see it on Twitter, Karthik, tomorrow. So thank you very much.
Where there is life, there is hope, there is meaning. But life has its downs as much as its ups. Life is about challenges. Life is about opportunities. Time for joy, time for celebration, and time to introspect. Thankfully, in every one of life's moments, and even beyond life itself, there's LIC. Where there is life, there's always LIC. Zindagi ke saath bhi, zindagi ke baad bhi.